Hi, welcome to another episode of Talking Tax with Alex. This is going to be a multi-part series and we'll talk about what we're doing differently in the upcoming slide. So here's our agenda. We'll start with the introduction, we'll go a little bit deeper, we'll talk a little bit more about what we're doing differently in this series. Afterwards, we're going to look at the list and we're going to look at the summary of our cases. Yes, there's more than one case this time. We'll be examining a lot of cases. And then we'll round it out by talking about the brazen. Who is the most bold, I think, of these cases. Then we'll look at the foolish. We'll talk about, in my opinion, who is the stupidest of these taxpayers. And then we'll round it out with some closing thoughts and just talk about some key takeaways. So what are we doing differently in this episode? We're talking about tax crime and the statute of limitations. This is all information that I got from the justice.gov website for tax crimes in the month of July. So we're not going to be looking at a whole lot. It's a small little microcosm of the justice system, but I figured there's not a lot of people and not a lot of content talking about white collar tax crime. I don't know anyone else that's doing it. I figured it's interesting enough. If you're interested in watching tax content like this, maybe you're interested in some tax crime too. The other thing I'm going to be doing a little bit differently this episode is I'm going to be referring to my other screen here to read some additional information about the cases, just so I can add some additional context, because I can't fit all of the case information sometimes, and I feel like it's going to be a better story if we can fill in the details on some of these cases. So having said that, let's just kick off our list. And this list is in no particular order, except that they all happened or they're all settled and closed in the month of July. So our first one is a Georgia woman was sentenced to 51 months in her participation in a nationwide tax fraud scheme. So what does that mean? Well, in this scheme, it was a larger scheme. The main promoter, would say that taxpayers were entitled to more refunds because of their mortgage and other debts. And so information was collected at these promoting events, these conventions, and usually these clients were charged about $10,000 to $15,000. These returns that she prepared 77 false income tax returns that collectively sought more than $23.8 million in tax refunds as per part of this scheme. And to kind of make it worse is she concealed her role in this scheme by, whenever she collected the information and prepared the return for one of these clients, she would have them report that the return was self-prepared. So just a red flag if you ever are encountered by a tax preparer and they offer to prepare your tax return, but then turn around and say, well, you have to prepare it as self-prepared. I don't want to put my name on it. That is an immediate red flag. Just don't do it. That should just, put off all your radar or your sensors. That should just set off a bunch of red alarms. Do not do it. It's really bad. So her role in this, she got about $500 per client and of filing these tax returns. And so when the entire ring, the main promoter, got caught and was sentenced to 11 years in prison, her role in this, she got 51 months, which is about 4 years or so. To make matters worse, she also claimed false business losses on her personal returns. So not only was she participating in this fraud scheme, she was also filing her own personal return with fraud on it. But I guess if you're already doing the fraud, what's claiming some business losses? You're already that deep into it. So yeah, this is our first case, and she's a fraudulent tax preparer. All right, our second case. 3 California men plead guilty to a $25 million tax and PPP loan fraud. So what is PPP? If you might remember, that's the Paycheck Protection Program that was initiated during COVID to help employers who had to deal with the whole shutdown. So in this case, and I'm just going to name the tax firm, it's Mana Tax Services in LA. they prepared and filed a series of false income tax returns for at least 9 professional athletes. So, that's bad enough. But then they also applied for Paycheck Protection Program (PPP) loans for several small businesses with grossly inflated payroll costs. So, to put a little more context into this and just how big this scheme was, um, they applied. They basically came up with these fraudulent tax returns, and they claimed to know they had specialized knowledge that their prior tax professionals, these athletes' prior CPAs, did not know that Mana Tax knew, so that they could apply for amended returns and apply for more additional refunds. So they purported to correct their prior CPA's tax preparation filings, and said, "Oh, we can do a better job. That we know a bunch of stuff they don't know." But they just made a bunch of stuff up, and they bolstered up the amount of refund that these athletes could receive. And then, kind of to hide their activity, they directed the athletes to send their fees. So they charged 30% of what they were receiving. They directed to charge these fees to a shell entity that they controlled. And then to conceal the fee even more, they had the money paid through cashier's check. They put that the checks are due to payroll. They basically used a bunch of shell companies. This was a big scheme that these guys were doing, and there's 3 of them, and they basically just committed fraud all the way through. They defrauded the athletes, and then they used a bunch of businesses that basically the business owners never saw the application before Mana Tax filed them, so they trusted them, and some of them were not eligible because they didn't even have payroll expenses, or they had not been in operation during the relevant time period. So it sounds like to me that they might have just opened up the business to apply for these loans. So it's a really good thing that the Department of Justice caught these guys, because it looks like they were just running amok, and they really at least financially hurt at least 9 professional athletes. Everybody in their tax firm. There's a lot of people that they hurt doing this crime. They face maximum penalties of 5 years for conspiracy charges, 20 years in prison for money laundering, and then they might get. They also face a period of supervised release. They were required to return $11.8 million of bank accounts, or sorry, $11.8 million of PPP money from bank accounts controlled by Havana and others. So Havana is one of the criminals, and they are set to be sentenced this coming September. So I think that's an exciting development in the world of tax justice, at least so that these guys they get what's coming to them. They really, I think they hurt a lot of people. Next on our list, a Louisiana taxpayer preparer, was sentenced to an additional 10 months for second fraud. So somebody couldn't get enough for their first helping. They just had to keep going. So this preparer, they prepared and filed returns reporting false income and withholding amounts to generate refunds for their clients that they weren't entitled to receive. It's a very basic level of fraud, but tax preparers might think that no one checks these things, or that they can just put a number in and they'll generate a refund and the client gets paid on the refund and it works, and that's probably what happens the first couple of times, and then they just continue and continue and continue. So this taxpayer basically filed returns that sought more than $550,000 in IRS refunds for clients, and this is their second offense. So they're sentenced to prison on another offense, and then they got an additional 10 months time on this offense. Oh, and just to boot, she falsified her own 2014 tax return. But I think we're going to see a pattern here where once tax preparers have given into the dark side and they commit fraud, that they feel there's nothing wrong to start doing it on their own returns. Next on our list, we have a gambling business owner who pleads guilty to tax fraud. So this one is interesting because we have a taxpayer who failed to report more than $2 million in income they received from two illegal gambling businesses he owned. So, if you don't know, if you are committing an illegal act and you are making money on it, you still owe tax on it. The IRS cares more that you pay your taxes on the illegal act than you are committing the illegal act. Obviously, once you're running afoul of the law, it really seems kind of far-fetched that you're an upstanding taxpayer, but you're committing an illegal, you're doing illegal business on the side. So, it kind of is like a catch-22. But the IRS would rather you pay your tax bill, and at least from the IRS's standpoint, you report your income, they're going to leave you alone. They'll let you do your illegal gambling business. That's until the FBI or the police get involved, and the police will take you down. So, I don't think the IRS cares in this degree, but that's how this taxpayer got burned. They got burned for not paying their taxes. And the most famous criminal ever that we know of is Al Capone getting caught, not by the FBI or anybody, but by the IRS for not paying his taxes. This taxpayer's co-conspirators also pleaded guilty for failing to report almost $2.3 million on their tax returns. So these taxpayers, they ran their scheme for about 9 years, 2009 to 2018, running two illegal gambling businesses where they filed false tax returns and omitted cash income they received by using a nominee to conceal the ownership. From 2012 to 2017, they did not report more than $2 million in income. And they also created a false purchase agreement where they purported to sell assets of the gambling business to a nominee owner's entity. So they're doing a bunch of shady stuff to generate or hide income and create losses. They face a maximum penalty of 5 years in prison for conspiring to defraud the IRS, and then they also face a period of supervised release, restitution, and monetary penalties. Their sentencing will come up soon in the future. Our next case is a Michigan endocrinologist who pleads guilty to tax evasion. So here we have a doctor who filed corporate returns for his practice, which significantly underreported gross receipts and overstated expenses, fraudulently reducing his tax liability. So, in this video so far, on our list so far, I have to say this is probably the most boring version of tax fraud, but it's also the most common. Not that doctors are fraudsters, but business owners and people that own their businesses, they get tempted by misrepresent their income, to misrepresent their expenses. I'm sure we've all heard it before. Some business owner, running their thing through the corporate account. It's just a very tempting predicament that business owners have. And in this case, this endocrinologist, this doctor got caught. So, fortunately, I guess they got caught for 3 years, and they caused the IRS to lose about $250,000 of tax. The doctor faces a maximum penalty of 5 years in prison for tax evasion and supervised release and monetary penalties and restitution. So he's going to have to pay some of that back, and we'll see what sentencing is later. He got caught for tax evasion. He faces up to 5 years. I'm not a lawyer. I have no idea if that's actually going to happen. That's how the Justice Department is reporting this. And so that brings us to the end of part 1 of this series. So just to recap, we looked at several court cases that examine all types of fraud. The first court case we looked at a Georgia woman who is sentenced to her part in a nationwide fraud scheme where the ringleader actually faces 11 years in prison. She filed a bunch of fraudulent tax returns, and then she insisted that the taxpayers sign their own tax returns as self-prepared. That's a huge red flag. We looked at a court case, we looked at fraudsters where 3 California men were running a firm that was filing fraudulent returns for professional athletes, filing fraudulent amended returns for those athletes, overstating deductions, overstating refunds owed. On top of that, they were filing fraudulent PPP loan applications that overstated the amount of payroll expenses for companies that might not have even existed in the appropriate time. It was just fraud all around. We looked at a Louisiana taxpayer who got her second sentence for fraud. Couldn't get enough the first time around. She committed fraud. She committed fraud at another company, and got a second round of fraud sentence to her by overstating deductions, credits, and overstating refunds. We looked at a business owner who pled guilty to tax fraud, and the gambling business owner was operating an illegal business. The IRS doesn't really care where you get your income from. If you get it through illegal means, they still want to tax it. So we saw the repercussions of that on top of the operating an illegal business. Now this taxpayer got burned for not paying their taxes on that income. And then finally, we looked at a Michigan endocrinologist who pleaded guilty to what I think is the most basic kind of tax evasion, is understating your revenues, overstating your costs. That's the temptation when you file your own tax returns and you feel like you got away with it the first couple times. The IRS will eventually catch you, and they caught this taxpayer. So some of my closing thoughts on this series and on this first set of cases is, I think the fraud takes many forms. We saw how fraud takes forms with just your regular old taxpayer preparing your returns and telling you that they don't want to sign it. We saw taxpayers who are claiming to know more than your prior CPA and can find refunds and find errors. So always just take it with a grain of salt. Sometimes it's true, sometimes it's not. And also, we saw loan fraud where they're overstating the applications and basically committed fraud on the application of the loans. Another takeaway I thought was interesting in evaluating these cases and why I'm doing this series is it's not just taxpayers, regular taxpayers, that are committing fraud and that are criminals. I found it very interesting that tax preparers are often the criminals in these cases as well, which is ironic because maybe not ironic, but tax preparers will know the rules. They'll know how to overstate things, and they'll know how to get maximum refunds. And if they're promising you that kind of stuff, it might seem to be too good to be true, and you should take that with a grain of salt. That's not to say some taxpayers or some tax preparers actually can find these errors made in tax returns and whatnot. I see it in my practice all the time. We get tax returns prepared by other enrolled agents or tax professionals, and there are legitimate mistakes. We file amended returns, we get legitimate refunds. And finally, just kind of to add an emphasis, an exclamation point to this point from the first case, your tax preparer, if you pay for a tax preparer, they should sign off on the tax return. Like if you're engaged or talk to somebody and they prepare your tax return for you and they say, no, I'm not going to sign this, and you paid them to do this, I would walk away from that preparer. Do not, request your refunds, or even if you can't get the money back, just don't let them file the return. It is a huge red flag. Paid preparers need to sign the returns that they are paid to prepare. So that's it for this episode. I look forward to exploring the second leg of this series. If you like this kind of video, please like the video, subscribe to my channel, and comment below or email me your thoughts. Do you like this kind of content? Do you want me to do anything differently on the presentation or anything? It's a new style of video for me. All kind of feedback would be welcome.